today's webinar. We're going to be covering a whole load of stuff. Hopefully some you'll be able to use straight away and you may take advantage of. Others, if not, you might be able to take away and use in the future. This session is being recorded and will appear on our YouTube channel later on today. So if you missed anything, you want to go back and just double check anything, you can go back and have a listen to it again, or drop me an email and we'll be able to sort something out for you, get an answer back to you. If we can't answer it today, then we will do. There is 6 years worth of content there on our YouTube channel, so please feel free to use that and have a look back and see if there's anything else you've missed. If you think you want to raise anything, go forward with a new sort of webinar, something else you want us to talk about, then get in touch and we'll put something on for you. Quite happy to do that. So any suggestions, more than welcome. As always, we have to start off with our usual disclaimer, which basically says the following presentation is produced for general guidance.
Wasn't a minute ago. Oh, it was.
And produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. So that's the housekeeping bit done, as they say. Let's move on. Oh yes, we're award winners. We're delighted to announce that we won the Professional Services Firm of the Year for 2026 at the East Cheshire Chamber of Commerce Business Awards. So that's something we're really proud of. Something which we're going to be putting out there, and it shows that we're an award-winning firm, which is absolutely fantastic. So I'm delighted to announce that we've got that. We have plenty of other resources available to you, so you can follow us on LinkedIn. We've got stuff going out there on a daily basis, Monday to Friday. Please feel free just to follow us on LinkedIn. You'll catch up with all sorts of stuff that's going on there. We're on YouTube. As I said, this webinar is being recorded and will appear later on YouTube. And we're also on Spotify. So we've got some interviews with some business owners who've seen it and done it. Feel free to look us up on Spotify, and if you've got something you want to listen to on the way home, just stick that on your drive home. Hopefully you'll be able to get something from it. And upcoming events. We have the following events coming up. Everybody's welcome to all of these. On the 11th of June, we have our Ladies in Business event from 12 till 2. And then on the 24th of June, our very popular Business Club lunch, which is at the Hollin Hall in Bollington. That's from 11:45 till 2 p.m. Typically we're getting about 40, 50, 60 people there, depending on who comes. And we had Porsche cars there last time, who's showing off their latest vehicles. You could have arranged a test drive and so on. Well worth coming along to some networking, hear some very interesting speakers, and enjoy some good food. And then on our next webinar on the 26th of May, we're going to be talking about mortgages. So watch out for that one, how to get one, what you should be putting in your references, what you shouldn't be doing, and so on. And we'll be talking to some experts in the field there. Quick update. What's new? Well, Making Tax Digital has finally started. It started on April the 6th. So we're now already a few weeks into it. What does it mean for you? Well, it only affects you if you are a sole trader and a landlord and you have combined turnover, that's turnover, not profit, in excess of 50,000 for a year. If you have that, then you are in Making Tax Digital and you have to make a quarterly return. We have a number of clients that are doing that. So if you feel you've missed out or you know somebody who needs some help with Making Tax Digital, feel free to get in touch. We'll happily sort you out. Tax increases. The big one that's going to affect a lot of our clients is the increase in dividend tax. That's gone up by 2%. So instead of it being 8.75% for a basic rate taxpayer, it is now 10.75%. So that's going to affect you 26-27. So you'll expect to see bigger tax bills come January 28 when you pay that balancing payment and then going forward. Shoot the messenger, please. Minimum wage increases as from April this year. So again, those have just gone up. So make sure you are paying the right amounts. The revenue are doing an increasing amount of minimum wage visits, and they will name and shame if you have underpaid rather, anything up to, say, I think it's only a few £100. So that's what they're doing at the moment. And finally, inheritance tax changes. Just be aware that your pension pot is now going to be forming part of your estate from April 27. So we've got a year to get your house in order if you wanted to do something about it. Get in touch if that affects you, and we can see what we can do. But it does throw long-term investment strategies and retirement strategies basically on the head. So again, let's see what happens with that. Okay, let's move on to our main subject of today. Tried to get as many T's in as I can, not sure why, but tried and tested top tax tips and tricks. We're going to look at a number of these. A lot of it's just vanilla planning. We're not going to go anything too dramatic, but it might be stuff you've forgotten about or you've missed or it's something you're not sure about. So we're going to go through some of these. And the first one is a bit of a freebie. So why not do this anyway? Trivial benefits. This applies to employees and directors, and basically you don't have to pay tax on a benefit for your employee if all of the following apply. It costs you £50 or less to provide. It isn't cash or a cash voucher. It isn't a reward for their work or performance, and it isn't in the terms of contract. That's all you need to fulfill for these conditions, and you can give away £50. There's a maximum, though, of 6 vouchers per year. So they are tax-free, they're tax deductible in the company's hands. Those are the 4 conditions, and the £50 benefit applies. So the sort of things we're seeing but regularly are non-cash vouchers, such as John Lewis vouchers, such as Amazon vouchers, where basically you can't swap the voucher for cash. So if you can say, right, I'm going to give it for, I don't know, we'll give you one for Christmas, we'll give you one for Valentine's Day because we love you so much, we'll give you one for Easter, stick it inside an Easter egg, whatever you want to do, but you can do all sorts of things, but you can give up to 60 £50 vouchers, that's 300 quid a year, you can have it for tax-free. Every little helps, as they say. So why not make use of that one? We see some clients do it, we see others that don't. Next one, electric vehicles. Well, this is always a good one. They are still very much a tax benefit in as much as if you're buying a new electric vehicle, and we're buying it, we'll come on to other methods in a minute. If you're buying it, then you get 100% relief. And that relief has been extended. It was due to run out in March 26. It's now been extended to March 2027. So how does that actually work? People always say this is a great benefit. So let's take an example. We've got, say, a £40,000 new electric vehicle. And we have a £40,000 new electric vehicle. That basically reduces your profit by £40,000. So effectively, you're going to be saving 25% tax on that. That means you're going to be saving £10,000 in tax. Just by buying a new electric vehicle, you get all the relief in 1 year. So you're getting 25% of the relief. For a smaller company, you might be getting 19% relief if your profits are below 50,000. But at some point, you'll be either getting between 19 and 25% relief on that new electric vehicle. The benefit in kind on that new electric vehicle for 26-27 is 4%. So if we take a £40,000 vehicle, that's a 4% benefit in kind, that's a £1,600 benefit. That's not tax, you only pay tax on the £1,600. That's a higher rate taxpayer, 40% payer, that's just 640 quid. For a basic rate taxpayer, that's obviously half of that, £320. So for £320 tax, potentially you could be driving around in a brand new electric vehicle and saving the company £10,000 on a 40 grand car. There is a small Class 1A national insurance charge, a couple of £100 for the company, neither here nor there. The other advantage as well is you can put the charger in. If you haven't got a charger in and you need to put one in, that's a tax-free benefit if it goes in at your home. So you can put that in. At the moment, they're about £1,500 to install a new electric charging point at your home. And if you need to use the car and you base yourself from home, there's no reason why that can't go in, and company can pay it and claim the VAT back on the installation. However, be aware, if you are leasing a car, that a relief doesn't apply. You still get charged the benefits in kind, but you will get tax relief on the lease payments as and when you make those payments. So it'll be spread effectively over the period of the lease. Now, there is a bit of an argument to say what is a lease for tax purposes and what is an outright purchase. For buying a new car, we actually have to see it actually bought outright or bought on hire purchase or bought on a straight loan, where you're paying the loan off over a period and there is no balloon payment at the end. What we're seeing a lot of is dealers coming out with agreements which say hire purchase agreements on the top, but actually for tax purposes they're actually leases, because there is a big balloon payment on the end. And that balloon payment is more or less the value of the vehicle in 3 years' time, as you'd expect it to be in a lease agreement. There is also an excess mileage charge in there as well. So effectively, if you've got an agreement which says hire purchase, just look at the terms, because for tax purposes it may well just be a lease and you will not get the relief all up front. Bear in mind, it only applies to new vehicles as well. Whereas a lease, it doesn't matter because you're not claiming capital allowances. Other than that, that is it on the electric vehicles. They are still a very good benefit. Still plenty to be gained from buying a new one at the moment, and it is running out in March 27. Will it get extended? Who knows? We'll have to wait and see what Rachel Reeves has got in store for us then. My guess is maybe not, but let's wait and see what's happening. Pension contributions. Now, obviously, you can make pension contributions, but if you make employer pension contributions via your limited company, that company will get the full tax relief on them. So, for example, you can contribute up to £60,000 in a year per director. Plus, you can use up any unused relief from the previous 3 years. If that's not been used up previously, that can be carried forward and used in the current year. So you have 60,000 for the current year, 60,000 the previous year. Prior to that, it was 40,000 and 40,000. So there is a substantial sum you could make as a contribution and get full tax relief on it as an employer pension contribution into your pension pot. So take, for example, £60,000 pension contribution, and the company's paying 25% tax rate, so you're going to save £15,000 in tax. That money then goes into your pension pot. You'll be able then to extract that cash at a later date, depending on your age, anywhere between 55, 58, depending on when you're born and so on. And it can be useful if you've actually got spare cash in the business, if you're not actually using it, because then you know that the income within and the capital within your pension will grow tax-free, and whatever it's invested in will grow tax-free. So it's a great way of extracting cash from your company directly into your pension and getting tax relief on that as well. It's probably one of the most effective ways of actually reducing your corporation tax liability at the moment. Moving on to the next one. Gift aid donations. We review a lot of tax returns each year, and I'm always surprised about how few people actually record their gift aid donations. Because for a higher rates taxpayer, it can make a big difference, because what effectively it does is the amount you make, the contribution you make, is then grossed up, and it has the effect of extending your basic rate band. So basically, for an example, if you were on £50,270, the basic rate personal allowance for basic rate tax, and you make a gross contribution of £1,000, that's £800, that's then grossed up by government to 1,000. Effectively then you have a basic rate band of 51,270. If you're a higher rate taxpayer, you've just saved another 20% on that contribution, so you save another £200 on those contributions. So it's well worth recording all of your gift aid donations and making sure they actually do go down on your self-assessment return, because if they don't, you're missing out, especially if you're a higher rate taxpayer. Basic rate taxpayers doesn't make a great deal of difference. Certainly for higher rate and top rate payers, yes, it does. You have to make sure that the entity that receives the donation is a registered charity, and there is a catch though if you are a non-taxpayer. If you're a non-taxpayer and you have made gift aid donations and the charity has claimed the gift aid, you end up paying that tax back because you don't get relief for it. So just watch out for that catch. It doesn't apply to many people, but it is there. So make sure the taxpayer, or even potentially the higher rate taxpayer, is the person who's making those contributions. That's the best way to get around that one. Next, business. Oh, don't we like a dog? Look at that. Lying there, fast asleep while you're working away. Anyway, dogs always look good on pictures, don't? Anyway, business use of home. Have you claimed this? So for limited companies, if you're a director of a limited company and you work from home, you can claim £6 a week. It's basically a fixed amount. You claim tax relief on it, so it's worth 300 quid or so. It's another amount which will reduce your corporation tax, not by much, but it's there. So limited company rules, though, are different if you're a sole trader and a partnership. So sole traders can claim a proportion of light, heat, council tax, etc. based on the number of rooms in a house that are used for business. You can then take a percentage based on the time that that room is used. So what do we actually mean by that? So let's take an example. You've got 6 rooms in your house. You might have 3 bedrooms, kitchen, dining room, lounge, or whatever. So you've got 6 rooms in the house. You use one of those rooms. Say the costs you've added up, you've got your light and heat and council tax and any other bits and pieces, they come to say £5,000 for the year. So you can take 1/6 of the £5,000, but you can't just take all of that 1/6 because that room isn't used solely for business. It's probably going to be mixed use, and therefore you could argue, well, I use that room 50% of the time for business, so you take 50% of the 1/6. It comes out to about 400 quid or so if you work on that basis. And also it gets round the probability or the possibility of anyone attacking the capital gains position, your principal private residence position, if you are selling your house at a later date. Because at the end of the day, you then have mixed use of that room. It's not solely business use for that room. It's just a little catch in the tail. It shouldn't affect most people. But bear in mind, that's the way the calculation is normally made. So for sole traders, partnerships, it's a great one. Limited companies, if you're working from home, it's a lot more restricted. So just be aware of that. Moving along. I had a look at the slide on this one, and I'm looking at this and I'm thinking, what on earth are they wearing on their legs? It looks like they've just been to some kind of martial arts class or something, and don't know whether they'd actually be able to transfer the marriage allowance between them if they've been through that. But anyway, that's another matter altogether. So if marriage allowance transfer, if one partner is not using their personal allowance, then the marriage allowance can be transferred to the tax-paying partner. So that's currently worth £1,260 at 20%. It's worth £252 a year. And you can go back and claim the previous 4 years. So now is the time to get onto that if you've not done it before. Both spouses must be basic rate taxpayers. It doesn't apply if either of you are a higher rate taxpayer. So basic rate taxpayers transfer the marriage allowance between you to get the most beneficial effect. If one person is a non-taxpayer, one of the partners is a non-taxpayer, then it makes obvious sense to transfer that allowance over to the taxpayer as long as they are a basic rate taxpayer, because that will save 252 quid a year. Go back 4 years worth, you're claiming up to £1,000 there, goes towards a nice holiday, perhaps, or even probably mending the marriage. Looking at those two on the sofa there after they've been going at each other hammer and tongs with those pads on their legs. But anyway, that's something else altogether. Moving on. We're going to look at use of dividends to split income. So if you've got husband and wife companies, you can always split the income between you. You can give some shares to your wife, or the wife can give some shares to the husband, and the dividends can then be split between you in the most tax efficient way. But then don't forget about your children. Anyone over the age of 18, any child over the age of 18 can have shares in the family company. Now, you will be giving some of the company away to them, and you can make them potentially different classes of shares. So this potentially is a good way of covering your child's university costs if they're going to university, because then you can pay them the dividend income directly to them. Chances are they're not going to have any other income, so they'll have the full personal allowance available to them. And as long as the amounts are reasonable and you're not taking too much of the advantage of this, then there's no reason why you couldn't transfer some money to your children to pay for their university costs funded by your company through dividends. And as long as they're a different class of shares which attract a different rate of dividend, you don't need to take the dividend at the same rate as they do. So there's various options there that you can do with that, splitting dividends between the various people who you want to. We've seen a number of clients of ours do this. It's a great way of university costs being paid. Doesn't really apply to school fees because obviously your children will be under the age of 18 at that point. But over the age of 18, then yes, potentially you can do it and have a different class of shares. Next, if we have a company year end not the same as the tax year, this gives you a little bit more flexibility, because if you've got a tax year end of 5th of April or 31st of March for a limited company, then you know all the dividends are going to be in that tax year. So for instance, 26-27, if your year end is March 27, all of your dividends are going to go into 26-27. If you have a year end of September, for argument's sake, which is 6 months into one tax year and 6 months into another, it gives you the option of moving dividends around between tax years and making sure that what you're actually extracting doesn't take you over certain limits. And it can keep you below certain income thresholds as well. The main one there being child benefit, because if your income goes above 60,000 a year, you start to lose your child benefit. So it's a great way of actually splitting income over two different tax years. Keeping your income below certain amounts can even keep your income below the 50,000 basic rate band if you wanted to. And if you're at a top end rate, maybe you can, at the 100,000 limit, you'd be able to keep your dividend income at below those sorts of limits. So it's well worth having a look at that as well, and making sure you can save tax on that basis, because it can save you considerable sums of money by having maybe a different tax year end. Not always great for some people. Some of you are not able to move tax years for whatever reason. Commercially, it might not suit you to have a different year end because of the seasonal nature of your business, but there might be other opportunities there if you wanted to. Trading allowance. You can earn up to £1,000 tax free, and that's selling on eBay and Etsy and so on. But the other thing is it a hobby? And if it's a hobby, then you don't even need to declare that income anyway. So for instance, some of you will know that I'm a cricket umpire in my spare time, and you get expenses for doing that, but it's not something I would consider to think of as a trade or as an income. It's a hobby. I do it for the love of the game. Certainly the remuneration that you get is not anything like that I would get if I was working. But it's a hobby. That's something I like doing, something I can give back. I've been playing for 40 years, and it's something I can then give back to the game. So as a hobby, no, I don't need to declare that on my tax return form. However, if you are genuinely selling eBay and on Etsy and so on, then yes, you probably need to declare that if you're doing that on a regular basis. There's an additional allowance of £1,000 for property income as well. So if you receive income from property of £1,000 or more, or less rather, then you don't have to declare that either. It's below the trading allowance as well, although it only applies to domestic property, not commercial property. And you can even have it as a deduction against your income as well. So if your rental income and you haven't got any deductions at all, then you can claim the £1,000 deduction. So there are restrictions that apply, especially around the property allowance. Anyone's got any questions on that, please feel free to just come back to me on that. Moving on, salary sacrifice. Now, the way this works is it saves tax on and national insurance, and it comes out of, it means the amount you've sacrificed comes out of your gross income. It works very well for low emission cars. So we've already talked about electric cars. What if we had a low emission or an electric car on salary sacrifice? So let's say, assume somebody's on a £60,000 salary. And the reason for that being is that we have got some at basic rate tax, some at higher rate tax. And they're running a comparison for a £40,000 electric car. And if we do all the calculations on that, somebody could be saving somewhere around about £3,500 a year, they're saving in tax. So there is a considerable saving in doing so, in having a salary sacrifice. So it's well worth having a look at that. There are changes to the rules in relation to pensions. You used to be able to say, right, I don't want a wage increase, I'll have it into my pension. You've just got to watch the rules now because those are changing. You can still do a salary sacrifice for a pension, and you can still do it for cycle to work schemes, hence the picture there. So you can do a salary sacrifice for that in as much as reduce your salary and provide a company bicycle, which somebody can use, and it's much the same here. You will reduce your salary for a company car. The reason why it works for electric much better than anything else is because of the benefit in kind rates that are out there. And because it's only a 4,000, we've only a 400, 600 or 300 pound benefit for a 40,000 pound car, it makes great sense to potentially combine that with using a salary sacrifice. Capital gains tax allowance. Make sure if you do have allowances, you do have investments, for instance, that you use up your £3,000 allowance per annum. It's well worth having a look at that. If you do have a number of investments, speak to your IFA. It's not something we're allowed to advise on investments ourselves, but it's well worth having a look at that. It has come down, this £3,000. It was much higher in earlier years. But if you are spreading disposals of your investments over a number of years, don't forget it is £3,000 per person. So if you've got joint investments, that'll be £6,000 will be of any gain will be tax-free in the first year. Just going to see if we've got any questions coming through. I've got one here, going back to eBay. If selling unwanted things I own on eBay, can I deduct the purchase costs and just declare the profits? Yeah, you can. And the chances are, if you're doing this as a trade, then potentially you will get caught by the £1,000 rule. But in reality, you're likely to be getting less than £1,000. Yes, there will be a cost to it, and yes, you can just declare them. We don't even need to declare it if you are just selling your own chattels and so on. But if you're buying stuff with the intention to create something and then sell it on Etsy or eBay or so on, then that becomes trading. If you're just selling off your old unwanted bits and pieces, that really isn't trading. Anyway, you'll be covered by the £1,000 allowance. Dividend allowance. Dividend allowance much reduced in recent years, but it's still just worth £500 per person. It used to be worth a lot more than that. But even if you haven't declared any dividends for the year, think I don't need to do anything, well, why not just declare 500 quid? It's tax-free money. You may as well just declare it even if you don't take the cash. So for limited companies, we just put through £500 per person, and it make use of the tax-free amount. It has been attacked by the government in recent years, and now with the dividend rates now increasing by 2% to 10.75% for basic rate taxpayers, it has come down considerably, and what is left is going to get taxed at a higher rate, but it's still well worth doing. And also don't forget, if the children have also got shares in your company, there's no reason you can't give them the £500 as well. If they've got other income, they might be over 18 and working somewhere else, they can still get the £500 tax-free amount. So it's still well worth having a look at that one, but not used as much. Mobile phones. These are a tax-free benefit. The main condition is get the bill in your company name. We have seen lots of clients where they send in the mobile phone bills and it's in a personal name. As long as you've got a business name on there somewhere, limited company name or the name of the company on there, make sure you do that. It is a tax-free benefit. The company can pay for all of it. But the main catch there is in relation to the VAT. If you want to reclaim the VAT back on the mobile phone bills, then you need to have the bill in the company name, or the company name's got to be on there somewhere. HMRC are going to be looking at this a lot more closely, especially where VAT invoices are not in the company name. But at the moment, mobile phones, tax-free benefit, put it through the company and have the company name on there. Next one, ISA allowance. Again, this means your investments can grow tax-free. So is it worth holding savings outside of an ISA? Because all an ISA does is it just puts a tax-free wrapper around your savings. So if you had £5,000 in a normal deposit account, you're going to pay tax, potentially take tax on some interest on that. But if you stick it in an ISA, it becomes tax-free. You still get access to it, you easy access to it, you can use it like any other bank account, but it's tax-free. The interest grows tax-free. And if you've got stocks and shares ISA, again, it just grows tax-free. You're not paying tax on any dividend income you might get out of it, or any capital gains you might get out of it. So you can get your growth going up tax-free. Typical growth rates, you're going to be 5% plus. We can't give advice on what you should invest in. Your IFA will be able to do that. Or just have a look and see what the best paying cash ISAs are around there. There's plenty of websites that will be able to do that. The limits are on there. They are changing. Rachel Reeves wants us to invest more in the UK and get us investing rather than just being in cash. That's entirely up to you, what you want to do with it. The returns, though, tend to be better if you are investing rather than just cash, but take professional advice on that as to where you should actually invest. Certainly for a higher rate taxpayer, it is very much worthwhile to protect your investment income from tax, and this is pure vanilla. Is it tax avoidance? Well, no, it's part of a government tax scheme which basically says you can have your income from an ISA tax-free, and from the growth in that tax-free. So make use of that wherever possible. Residential properties. What do we mean by Form 17? Well, basically, if you've got a property that's held in joint names, then you can split the income in a way which is most beneficial to you. Yes, you'll need a lawyer and there's paperwork to complete. But say, for argument's sake, you've got a property income where it's owned jointly by a husband and wife, where one partner is a higher rate taxpayer and the other is a non-taxpayer at all. What you can then do is say, well, actually, the income that the person who's a higher rate taxpayer is going to pay a load of tax on that rental income or rental profit. should there be any, they're going to pay high rate tax on it, whereas the partner is not. You can then decide to say, well, actually, we want to split the profits and the income from that property in a different way. And you can do that by filling in this Form 17, amending the land registry, and just get a lawyer to do the paperwork. It costs a few £100. That way, then you can say, right, I'll have the non-taxpayer receiving maybe 95% of the income, and I'll receive 5% of the income. That way round, you can then shift the profits to the non-taxpayer, save tax on that basis. Potentially, for instance, if you've got £10,000 of the rental income, it's split 50-50. The higher rate payer is going to pay £2,000 on that, and the non-taxpayer, well, the basic rate taxpayer is going to, no, higher rate taxpayer is going to pay £2,000, being £5,000 at 40%, and the non-taxpayer is going to pay nothing. So why not split it the other way around and have it say 95% and 5% and save up to £2,000? Fairly simple to do, and it can be changed back again later on if your circumstances change. So well worth having a look at that one. Looking at SEIS, EIS and VCT, what do all those letters mean? Basically, seed, enterprise investment scheme, or the enterprise investment scheme, and venture capital trusts. These are more risky, but you get good tax relief on them. We can't tell you whether to invest in them or not. It's financial advisory territory. We only can comment on the tax point of view. But effectively, EIS, you will get 30% relief, VCT 20% income tax relief, and SEIS up to 50% relief, depending on certain conditions. But you can lose all your money in this case if the company doesn't succeed. But you will then get tax relief on losses as well. So potentially, you can make some good tax savings on looking at enterprise investment schemes and the venture capital trusts. If you're into that side of the market, get in touch with your financial advisor. He'll be able to point you in the right direction for that. Inheritance tax. Rules are changing from April 27, when pensions will then be part of your estate. So at the moment, they're not. Does that give you some opportunity for tax planning? Maybe. Everyone's circumstances are going to be different, so there's nothing general I can give you on how you could save tax on that, but that's more something to be aware of. However, the usual rules still apply. You can still give gifts, and so as long as you survive 7 years, that gift will then fall outside of your estate, as long as you don't retain any interest in that gift. So, for instance, if you wanted to give away your house and then continue to live in it, that doesn't work for inheritance tax purposes, because you're still receiving the benefit of living in that property. But you can survive for 7 years, give the gift away, falls outside your estate, and there's no inheritance tax charge on that. You should be considering a lot more of this, because I imagine that a lot of people's estate is going to be made up of their own home and their pension fund. And if you build up a considerable pension fund, that's all going to get taxed now at 40%. So the more you can give away early, then the better it becomes. The other one is a good one of regular gifts out of income. So potentially you could draw money down from your pension scheme on a regular basis and say, well, actually, I don't need to live off that. And you can give away, for instance, you're drawing down, I don't know, £5,000 a month, for argument's sake, from your pension fund, and you only need to use £4,000. You only need it for income for £4,000. You could give £1,000 a month away. And as long as you establish a regular gift out of income, then that will fall outside of your estate as well. So it's something that is well worth having a look at. It doesn't have to be as regular as monthly. It could be every 2 or 3 months. It could be 6 monthly. But as long as you can show a pattern of giving regular gifts out of income, then that potentially will fall outside your estate for inheritance tax purposes. And don't forget, you've got your annual gifts allowance of £3,000, and you can use your prior years if not used previously. So each person can give £3,000. If you haven't used last year's, that's £6,000. And if it's 2 people giving it away, that's £12,000. So potentially in year 1, you could give away £12,000 out of your estate. and an ongoing £6,000 a year outside of your estate. And there are other exemptions as well for things like weddings and so on. So any questions on that, again, come back to us. Research and development. The rules have been tightened up a lot, but there are still incentives to this. You have to make a declaration to HMRC prior to making a claim now. So you can't just stick in a claim. If your company is doing research and development, then you need to get in touch much sooner than you used to, because you have to put in a claim to say that you are going to be making a claim going forward. There has been a lot of fraud in this area, hence the reason why HMRC have clamped down on this significantly, and it has to be genuine research and development. If you want to understand a little bit more about that, then please feel free to get in touch. We do all our own research and development tax claims. We will advise you all the way through that as to whether it qualifies or not. So please feel free to get in touch on that. And finally, if all else fails, rather, then you can always move abroad. Funnily enough, this isn't so daft as it sounds. We have a lot of clients. We have a lot of clients who are considering moving abroad, especially over to Portugal. We have one member of our team who's a specialist in moving people to Portugal. The number of inquiries we have seen is considerable. We have had clients already move abroad with lower tax regime, but it is something that you can't just do on a whim. Obviously, you just need to take professional advice. Obviously, there's a life choice decision there to be made as well, but you can consider moving to reduce potential capital gains liabilities. We've had other clients move to the Middle East, and well, obviously with what's going on there at the moment, there are other considerations to take in there, but it is something that a lot more people are considering, bearing in mind the way the tax regime is here in this country is going. So we've now got the highest rates we've had for quite a number of years, and it is off-putting for certain people, so they do consider moving abroad. So any questions? Is a new website research, and I think that should be research and development? No, it isn't. Research and development has to be something which takes a technological advantage, takes something forward. It has to be a new technology going forward. It has to be something that's not been done before, or something that's been doing something completely different way. So no, new website won't apply, I'm afraid. You will still get tax relief on that new website depending on how it's been done. So if you're setting up a brand new website and you spent a fortune on it and it's one that generates income, potentially you could have that as capital allowances on it, or it's just a new website, will just go through the profit and loss account either way anyway, if it's just a normal one. So I'm afraid not for that one. Any other questions? Anybody else want to raise anything? Please feel free to unmute yourself or stick something in the chat box. As I say, we've recorded everything here, and hopefully we've covered quite a lot there of basic stuff which you can use. Nothing that's too aggressive there. It's all standard stuff. You can take away some of those and apply them to your current businesses now, and take advantage of that. Even if it's only for a few hundred quid, it's well worth doing anyway, because you may as well. If it's tax-free money, why not have it? Typical one most people don't make use of is the trivial benefits one, the very first one we showed. For 300 quid a year, have 300 quid a year, and two directors 600 quid a year. Why not? You can take 50 quid out at various times during the year. So I hope you've enjoyed that session this morning. If you've got any subjects you want to raise on us, then please raise for us. Please get in touch. If there's any webinars you'd like to see in the future, again, please get in touch and we'll be able to put something on for you. But that concludes today's session. Thank you very much indeed for joining us, and hope to see you soon. soon on the next webinar.